Hello and welcome. I'm Vijay Srinivas, and we're joined by IDFC Chief Economist Gaura Sengupta to discuss the Modi government's GST Reform 2.0, where the council has agreed to switch to a two-tier tax structure. Thank you very much indeed for your time, ma'am. And with Indian exporters sort of bracing for a hit from the Trump administration's tariff, the government's move to rationalize GST into two slabs seems aimed at boosting the domestic economy there, right? So do you believe that this reform will meaningfully spur consumption in the coming months? And how do you see the 5% to 18% structure shape the retail demand in India?
Definitely, it's a very good move. I think apart from the significant tax cuts, in a way, the earlier indications were that majority items will move from, let's say, the 28% bracket, majority will move to the 18% bracket, and majority in the 12% bracket moves to the 5%. But we are seeing is that certain items which were, let's say, in the 18% have moved to the 5% bracket also. So in a way, it compared to what we were hearing in the press earlier, they've given even a little more than what was expected. So, and also the timing, it's in line with the start of the festival season.
That's right.
So that will also help. And the implementation of this sort of rationalization so quickly is definitely a positive. So we see growth getting a support of around 0.6 percentage points over a 12-month period. So that assessment of ours does not change. Our full year growth numbers for FY26 are stacking at 6.6. We've already incorporated, because earlier on 15th August, the Prime Minister had already indicated that GST will be rolled out. So we had already incorporated that in our FY26 estimate. The other issue is some part of the impact of the GST will be countered by the tariffs. So on a net basis, I would say if let's say the 50% tariff prevails, GST boost, the impact will be kind of outdone by if a 50% tariff stays till March. Our baseline is that, let's say, by November or December, the tariffs on India goes down to 25%, not from currently 50, and then we have 25% till throughout. Then we get a 6.6 GDP with some boost that we're getting from the GST also.
It is estimated that the revenue loss from GST could be about 48,000 crore based on 2023-2024 consumption figures. Do you see this as a worthwhile a fiscal sacrifice if it accelerates consumption, as the government anticipates to be?
Honestly, it will be much more effective than the income tax collection, the income tax cut. So we've had a very substantial income tax cut under the new income tax scheme, where majority, 70% have already shifted, more than 70% have already shifted to the new income tax scheme. But we are not yet seeing the impact. That maybe the impact will take some time. It may come more in the second half. And also the number of people that got the benefit as a proportion of the total population is very small, because the number of people who are paying positive income tax is extremely small. Indirect taxes have a wider reach. It's able to affect people, on a wider scale. And here, what we are seeing is certain mass market items. They have really seen a sort of a drop in tax rate. So, and the combination of it getting rolled out just in time for the festival season, that is also positive. So, from a tax perspective, I would say the GST can give a better boost than the income tax cut could have. So it's definitely a positive.
That's right. Okay. Given GST is a major source of revenue for the states as well, to what extent should the center, you think, that should step in and with compensation mechanisms for the states, which are more reliant on the abolished 12% and 18% tax slabs?
So basically, the center is saying the total cost to center plus states is 480 billion. That's our interpretation. They didn't say whether this is only for the center, whether this is only for the states. So from the press conference, it looks like the 480 billion is the cost for center plus state, and this is for a 12-month period. So 480 billion means there'll be hardly any cost to the center because we have only half year of the fiscal left in FY26.
And also the fact that of the indirect taxes.
Correct. And also the fact that about, let's say, 60 to 70% of the hit will be on states. But again, it's a small amount if you take the 480 billion. And as a result, there is no mechanism for compensation that has been rolled out. And moreover, the cess will come to an end. Only cess on tobacco will persist. And that is also till the time they pay the loans that they gave the states during COVID. And that I have, past reports from the press was reporting that the government is planning to finish that payment by November. So we assume that, let's say, till November, you will have the tobacco cess, which actually contributes quite a significant chunk of the cess collection. But obviously, you'll see some cess loss because the other items, cess will no longer be put. But our estimate of total fiscal cost for center plus state is a little higher. So we are seeing maybe, let's say, we've got for center plus states, instead of a 450 or a 480 billion uh, sort of cost, we can see a cost of around, I think, approximately 950 billion. Again, but this is for center plus state, which is 0.3% of GDP, and it is for a 12-month period. If I look at FY26 alone, given the fact that, let's say, roughly half of this is only left for FY26, and the center, because it shares its revenue with states, it gives 41% of CGST to states. The hit on the center, even on our cost analysis, is less. Yes, there is some impact for states, maybe around less than 0.2% of GDP for states on a 12-month period. But I don't think there is a compensation mechanism that is going to come up for the states, given the fact that center's assessment, which obviously will be much more accurate because they have a full set of the data and they are aware of the collection that are coming from the various tax bracket. So if you go with the center's estimate of total hit, then I don't think a compensation mechanism will come for states.
Okay, so capital expenditure and consumption are the growth drivers and triggers for the Indian economy there. Now, how do you see these GST reforms 2.0 sort of complement this particular framework? And do you also foresee RBI rate cuts in the coming quarters?
We definitely still expect a rate cut. We see one more rate cut. The timing is a little different. So we are still saying October or December, but we are seeing a better chance of an October cut because one, you get the GST. So RBI will want to see the impact of the GST on the festival season and then take a call whether monetary policy needs to also add to the boost to growth. Second, we also expect the fact that by December, you'll get clarity on the tax, on the bilateral tariffs. Let's say assumption is if you see, let's say Piyush Goyal had also mentioned, the minister had mentioned that by November, December, we should have a lower tax rate. So again, the December meeting seems more live from these two perspectives because RBI will want clarity on these two factors, the tariffs as well as the impact of GST, as well as they'll want to see how the festival season demand is playing out. The Q1 GDP numbers were exceptionally good. There was 7.8%.
That's also because the
Q1
GDP deflator, isn't it?
That's our assessment. A chunk of it is a GDP deflator. A chunk of it is because a lot of one-off factors. For example, you have very strong base effects in Q1. Government capital expenditure, center plus state, double-digit growth in Q1. Its expectation is that the capital expenditure will slow down in the second half, as because the revenue side, the tax revenue side is not doing so well. So they will tend to moderate their pace of expenditure. The other one-off is the tariffs itself, because we've had front-loading of exports from India to the US. In FY26, our exports to the US were tracking at 20% plus in the first half because there was front-loading. And in Q1, we had by a pause period tariffs of 10%. So India was a net beneficiary. So taking all those into account, yes, Q1 was expected to be good. It was much better than expected. But the trajectory of growth in the second half, for example, the first half can average around 7.5%. Second half growth is expected to be somewhere between around 6%, slightly above 6%. So right now, a lot of people are saying, for example, that RBI is indicating that when they look at the forward-looking trajectory of inflation, that Q4 inflation is 4.4, Q1 inflation is 4.9, hence the space to cut rates is less. we would argue that we should also see the forward-looking trajectory of growth. But because the Q1 numbers were so strong, we feel that there's a higher chance that they might want to wait, see how the festive season pans out, how the tariffs pan out, and then cut in December.
Okay, so I also want to focus a little bit on the insurance sector. The government is considering zero rating insurance premium from GST. How could this affect household spending, financial behavior, and then the broader life and healthcare insurance segment?
Not just the insurance segment, but you look at even for medical products, medical devices, medicines, there has been significant cuts that have been given. Many of them have been shifted to the 5% category. Again, it's for insurance, there is a zero tax sort of being proposed. Now, I'm not an insurance expert, but we'll have to see how does it translate in terms of premiums, because once you don't have tax, GST, you don't even have the input credit. So on the net basis, you need to see whether premiums become cheaper or how much cheaper. But yeah, I mean, let's say if insurance premium falls, again, I'm not an insurance sector expert, but if let's say they become a bit cheaper, then yes, it will incentivize more people to get this highly essential service.
Okay, so one last.
But we'll have to see what is the net incremental impact on premiums.
Okay, one last question there. I mean, usually reforms kick in, especially when the external factors, the economy isn't doing really well. So 1991 reforms came in on the backdrop of Indian economy not really doing well. It was really worse at that point of time. You have it sort of GST reforms also come in right now. Are you really surprised? Because, if you really talk about the GDP, it's 7.4%, bang on Q1 target, fiscal deficit 4.4. But, if all conditions are so good, the reforms kick in right now. Do you think there is something not really okay and then the reforms had to come in? Or do you think this is something that certainly have to spur consumption and the government is doing it on that particular notion?
I think, yes, the GDP numbers look good. But if you look at nominal GDP, that is 8.8 in Q1. Previous quarter, it had grown by 10.8. You look at income tax collection, you look at corporate tax collections, you look at listed company profit growth. For example, listed companies, this is based on RBI's assessment of listed companies. So we haven't, done anything to the data. But looking at services and manufacturing, the sales growth in nominal terms is continuing to slow. You look at FMCG sales group for urban side, it's not doing so well. Rural is definitely on the better side. Private capex is not yet come to the fore because of so much uncertainty. You have uncertainty on exports. Yeah. Domestically, companies are seeing this sort of muted urban demand, so they are taking their time. Government capex has definitely been a support. So yes, we are in a strong position right now, but yes, we do definitely need some fiscal support to ensure that the consumption side, the urban side, get some support, especially in this sort of environment where external is going to be very tough, given the escalation in tariffs. And we are just talking about the first round effects of tariffs on India. There's also a second round effect will come when global trade starts to slow, which none of us can actually encapsulate properly. So yes, I mean, yes, we are in a strong footing right now, but we are facing a very challenging environment, and we need fiscal support, especially to boost consumption, and in particular, urban consumption. That's what both the income tax cut is trying to do. That is what the GST tax cut is trying to do.
Thank you very much, man. Pleasure talking to you. Thank you.
Thank you so much.